Hi everyone, hope everyone's had a great August and managed to maybe get a bit of a break in, whether it's overseas or in the UK. So we're at that time again where Zoopla releases its UK house price index. Now I wanted to make a certain point in this one, especially as if I've seen a number of newspaper articles saying how much the market's fallen since the stamp duty relief ended, or part of the stamp duty relief ended anyway. There's a bit of a myth in that. There's certain massaging of figures to create a headline. Because the reality is when you're at an all-time high, any drop is going to be pronounced. But the reality is we're still well up year on year. So behind the figures, there's some definitive truths that I want to go through in this. So look, well, without further ado, let's dive in. We can see still the house price growth is up 6%. So the overview of this report is the house price growth for the average of the UK still up 6%. Demand for homes is again still up 21%, and of course we've got the flow of new supply. Year to date is down 3%. We're going to go into those figures in a little bit more detail here, but let's have a look at the overview summary. So the total stock of homes for sale is 26% down from 2020, and that's going to remain low. Now that's just not, again, you've got a bit of a confusion here in terms of the flow of supply. There's a slight difference here. This is actually 26% down overall. So what Zoopla will do is it will see how many properties, it's a very straightforward calculation, how many properties are on the market as of now in comparison to this time last year. And they can see that it's 26% down. In terms of the sales, they can see the same thing. The moment something's clicked as a sale, they will also look at the land registry as well. The sales in the last year have eroded supply because there's been a huge number of first-time buyers and investors, and we're going to come to the investors part later. So supply constraints are quite considerable. Again, at the moment, they're more evident for houses simply because people that can actually afford to buy, first-time buyers, they've gone and bought. There was then that need for search for space. So again, the supply is really restricted for houses. Flats, not so much on average. But in the city centres, yes, we have still seen the actual supply of flats falling for two reasons. One is due to the amount that are being purchased, and the second is simply due to the construction side, which we'll come to in a bit as well. So you can see here the mismatch in demand and supply, that's what's supporting growth right the way through. So it's 6% in July, up from 2.3% in July 2020. So the average price growth for houses is 7.6%. Compared to 1.2% in terms of flats. Now, again, when we advise on our flats, we are looking at city centres. We're not saying that it's an average flat. If you go out into the suburbs and you look at purchases, the reality is houses will be more popular to purchase than a flat, simply because people are looking for that extra space. But when it comes to city centre, that's slightly skewed because people are always looking to be in the mix of it and in the hub, which then brings everything back to apartments and back to flats. The market is still moving twice as quick as it was in 2016, with 26 days on average to sell, down from 49 days in 2019. So if we actually come down, I'll skip a little bit of this and come back, but if we actually come down, you can see there's a map of the UK and where is actually, or what areas are going the fastest. So everything sort of to the right of the spectrum in the pink, it's taking longer to sell. Everything purple and deeper purple is taking shorter to sell. So we can see here, if we sort of zoom into like London, you can see things take a longer time to sell in London. Now, the key areas here is sort of on the southwest coast. You can see obviously a number of holiday homes would have been purchased in that area there. And importantly as well, this area here, this is Liverpool, heading sort of to the right towards Manchester, Leeds. All of these areas are taking very little time on average for a property to sell. And of course, we've got the Scotland up here. So what I would be focusing on is looking at areas where it is quick to sell, but also being realistic in terms of the price point that you are paying. So many people are going and making below market value offers, when the reality is that it's a seller's market at the moment. They can sell the property to someone else within 10 days and they can get a larger offer. So we need to be realistic in terms of the offers that we are placing. So then as we head back up, let's head back up to the top and then we can go into a bit more depth in regards to the figures. So in terms of the annual UK price inflation, average house price rose by 1.4% in the 3 months to the end of July. But overall, the annual rate of increase is 6% this year, up from 2.3% where it was a year ago. Average home across the UK now is 234,000. That's a dramatic increase. Even in the time over the last decade, I've seen it increase dramatically. But 234,000 is where it is now. I think that's going to slow down in terms of the rate of increase. Do I think it will drop? No, not at the moment. But do I think that there will be a slowdown in the rate of increase? Yes, I do. Again, we can see where the highest price, the actual highest growth is happening. Liverpool, again, it's got here, continues to lead the way, 9.4%, which is eye-watering year-on-year turnaround. So people that were with us 5, 6, 7 years ago getting Liverpools for 80, 90, 100,000 are now seeing dramatic increases in terms of their prices. But again, it's still saying that Manchester's punching above its weight, and of course Belfast as well. Those areas are still fantastic in terms of where to buy. London, again, we know that London is going to trail behind. The prices in London are still, in my opinion, too high to create any form of investment market. So I would still be looking two areas. I'd be looking in the north, but I'll also be looking within a 30-minute train ride of London, because people still are going to start to flood back to London as offices start to open up again. So we then start to head down to why. Again, you've got here the rise in home values is being underpinned by the lack of supply in the market. Now, this report doesn't go into this, but there's a couple of reasons for the lack of supply. First of all, we've already been explained that one lack of supply is simply due to the fact that the amount of sales that have taken place has meant that the property market has had to scale back what's actually available because the number of sales have taken place. But there's another 3 main reasons why there's a lack of supply, which this report doesn't go into. First of all, less and less people want to put their home on the market at the moment due to COVID. There are a number of people that are still concerned about COVID, and totally understandable. But what they don't want to do is they don't want to invite people into their home on a regular basis. They don't want people traipsing around their home, so they simply don't put it on the market. They're going to wait. They're going to wait a year or two to actually start to put their home on the market. That's one reason. Another reason is the fact that when the construction industry closed in March 2020, it didn't know what it was doing. And when it did reopen again, it was a lot slower than what it was pre-COVID. So things got done a lot slower. There were little things. For example, you had to, if you used a certain piece of equipment, that piece of equipment had to be cleaned. And then again, certain things take time. In the end, I'm sure that people sort of bypass those rules. But the reality is when they first got put in place, you couldn't work closely with someone. So again, certain jobs couldn't get done. So the construction industry really slowed down. Now, I don't think that's going to have an impact immediately, but I think over the next 6 to 12 months, we're going to see an impact of a lack of new homes coming through. So I think that's going to create a supply shortage as well. In regards to the last point, the prices have dramatically increased for things like plasterboard, piping, everything has dramatically increased. So some developments where they had a certain budget in mind, the costings have actually increased by 30 to 40%. So what's happened is they've slowed down. They've simply slowed down and thought, well, we'll wait for things to even out. Otherwise, what would happen is the development doesn't make a profit. If it doesn't make a profit, well, there's no point in carrying on with the development. That's the reality of how developers look at it. So what they've done is they've slowed things down. And again, that's really sort of strangled supply as well. So overall, what they're looking at moving forward is we expect house prices to show an average rise between 4 to 5% for the whole of 2021. Personally, I think moving into 2022, we're going to sort of start to taper that a little bit between 3 to 4% as things start to sort of even out a little bit. But I still think we're going to have this constant lower levels of supply for, a good year and a half at least. And because of that, that's why I still think that the market's going to be pushing on. So as we sort of move down, we can start to see the amount of sales agreed. You've got sales agreed ticked up again in August. They're still down in compared to early April. Again, that's when people were rushing in to beat the stamp duty, but they're still 21% above the levels seen at the summer of 18-19, and that's a huge increase. Again, as we look at the average price growth in comparison to flats, we can see that actually the house price growth has constantly beaten apartments, but again, that's slightly skewed because that includes flats everywhere in terms of the suburbs. I can pretty much guarantee that if you took it for just city centres, that would be reversed, because predominantly city centres are made up of apartments, not houses. We then start to head down to first-time buyers. Now, first-time buyers have had it tough. 2020, they got squeezed out, loan to values, banks didn't want to know about first-time buyers. But now we're sort of getting more backing from the government. We're seeing a lot more increase of first-time buyers getting on board. What's now going to constrain first-time buyers is supply and price increase. But in regards to mortgages, it looks like some first-time buyers are actually starting to get some more support in the market, and that's enabling people to start to push on. And what that does then creates this domino effect where the old first-time buyers become second-time buyers, and so on. The market can then continue to increase up. So a lot of the market does depend on the first-time buyers. As we then sort of head down, we can see here cash owners, investors. Now, this is a big increase. So you've got here 24%, and then you've got sort of buy-to-let with mortgage. So we've got sort of 33% of the market of the share of sales. 33% of that was actually by either cash owners or investors or buy-to-let with mortgage. So investors, basically. So a third of the market was investors. Then we're pretty much just shy of a third for first-time buyers, and then home movers as well. So it just shows you that investors are really flooding back to the market in droves in comparison to what they were 12 months before. And then we sort of head down to the best cities. So we know everything about the market moving faster. We've got the map there, and we're going to send this out to everyone. But in terms of the actual cities and where people are buying, again, it's still pretty much the same top 10. We've got Liverpool rocketing ahead at 9.4%, Manchester, Belfast, Sheffield, Nottingham. All of those cities there are really sort of driving the market up. And we've got, of course, down the bottom, Aberdeen. But the reality is it's all about, from our perspective, investing in the north. That's where the market's been for the last, 5, 6, 7 years plus. But now we're seeing these pockets down south, just half hour from London, whether it be the Ashford, whether it be the Red Hills of this world. And those are the kind of areas which, in my opinion, when you're getting prices for 220 for a 1 or 2 bed flat, they're areas that are really ripe for the picking as well. But look, any questions you've got, feel free to put those to me or any of your brokers, and hope you have a good rest of the week.